Assalamu alaikum everyone. Hussain Qazi here, your facilitator for SBR Practice to Pass December 20 for SBR subject. Assalamu alaikum once again, candidates. If you people are hearing my voice clearly, do reply me. Are you people hearing my voice? Hello, assalamu alaikum everyone. Hussain Qazi here, your facilitator for SBR Practice to Pass session. If you people are hearing my voice, do reply me accordingly. Oh, thank you very much, Zubair. Thank you very much, Salima. Thank you very much, Wahab, Nashad. बहुत बहुत शुक्रिया. Oh, I'm sorry. Thank you very much. Jazakallah khair. Thank you very much, Pankaj. Okay, candidates. I hope that you people are getting confidence and I hope that based on the last 4 sessions, you got confidence on the with respect to SBR paper, and it created a value for you. And inshallah ta'ala, may Allah willing, by today's session you will get more confidence. We are trying our best to deliver um, the value things with you people. And do remember important thing, this SBR Practice to Pass session is about to patch up the or to bridge the gap between the examiner expectation and your delivery at the examination. So we have been trying with our team that we will deliver in that manner, that the core areas where you people are struggling and not able to write the answer according to expectation, so sort out that issues. Based on this 15 hours, we cannot deliver the complete syllabus areas, but the gray areas where you people are lacking, you people are facing trouble, that's why we are focusing on that particular aspects. Okay, let's start the today's working. Today we will discuss a lot of things, and do remember that I will extend the today's session by at least 20 minutes more, 20-25 minutes more, because today's agenda is about financial instrument, a quick briefing and the exam context, IFRS 15, somewhere about IFRS 15, IFRS 16, then something about IFRS 15, and the conceptual framework, and some little bit more thing about the performance measurement. If something remains with the end of the session, that I will upload the things on my YouTube channel. You can access accordingly, specifically for the current development. Although I have also discussed something about some little bit about the COVID-19 aspects related, but more aspect I will discuss and upload on the YouTube channel. Okay, candidates, let's start the matter of the financial instrument. That is about the topic which people are facing a lot of trouble. So a quick brief review of limited topic of the financial instrument and some exam context aspect. Okay, number one, financial instrument. Related to financial instrument, you have to work out with respect to IFRS 9, IS 32, and IFRS 7. These three standards basically belong to financial instrument. And candidates, the important thing is that what includes a financial instrument. The very important thing is that financial instrument is actually about any contract between the parties where one side financial asset, another side financial liability. One side financial asset, other side equity instrument. So if you need to require put the description of the financial instrument, you have to mention that a contract where one side the financial asset and other side financial liability. Any contract that one side the financial asset, other side the equity instrument. You, for the sake of the revision, for the revision purpose, I strongly suggest that you have to make a list of all the things related to financial instrument. Number one, the very important thing about the definition related to financial asset, financial liability, and equity instrument. That's a very important and key thing. Recognition, initial recognition is the very important thing. Then measurement and classification. Initial and subsequent. You have to know about that for all the financial instrument. Financial asset impairment is a very critical thing. We will discuss here a quick briefing about the financial asset impairment as well. We'll discuss here. Then financial asset, financial liability derecognition. Very important thing, that is derivatives. That's we have already done. And contracts, special consideration. Contracts with entities on equity instrument. That is with derivative, without derivative, both. With derivatives and without derivatives means executed contracts. And the very important thing, hedge accounting, and I suggest that don't ignore disclosure. You must have to read at least one about the IFRS 7. We are not able to discuss the 100% thing related to financial instrument right now, but you can we just pick something accordingly. Number one, the very important thing, whenever you are discussing the term the financial asset, so number one, you must have to develop your mindset about the definition. You have to stick with the definition. Cash is the financial asset. Contractual right to receive cash flow, that's a financial asset. Example, debtors. Example, debtors. Example, loan receivables. Example, investment in bonds. These are all under the umbrella of contractual right to receive cash flow. You can say lease receivable. More definition, that's about investment in equity instrument. This is what about the definition of the financial asset. Some more thing about the financial asset. We can say that derivatives under favorable condition. You must have to know that. Favorable condition. Like you are holder of forward and future contract and situation is favorable. And the case, always the case of option holder. Always the case of option holder. And very important definition. Listen carefully. Own EI, equity instrument. Listen carefully. Own equity instrument. Buyback contract where numbers of equity instrument is variable. I will discuss in a detailed manner in this case. Own equity instrument buyback contract where number of equity instrument is not yet decided variable. This is what a quick definition of the financial asset. All these contracts are financial assets. All these assets. Number two, very important thing. Candidates, listen here. Initial recognize. First thing, initial recognize. First thing, when become part of contract, you must have to know that. When to recognize a financial asset? When become part of the contract at fair value. At fair value. And about the transaction cost, I will discuss later. Number three, couple of minutes. Initial recognition. Classification and measurement. Now, listen here. Classification measurement. Although accounting standard says that classification measurement, fair value, P&L, OCI, irrevocable. OCI irrevocable means subsequently not possible to reclassify. And amortized cost method. Amortized cost method means where two tests qualify. BMT, business model test. Business model test means the company have an intention to held for maturity. HTM, held for maturity. Plus cash flow characteristics test. Cash flow characteristics test means instrument, sorry, instrument, only cash flow characteristics. Now quickly, the classification is about accounting standard. But another way, I can say that, another way, classification and measurement, another one. You can retain in your mind classification and measurement like this. Number one, if I say that investment In equity instrument, only one classification, only one, fair value. PNL, OCI. Short, S3, short-term purpose, fair value PNL. Long-term means strategic purpose. Long-term means strategic purpose. Classification. Other way, I can say that investment in DI, debt instrument, amortized cost method, if meets both tests. Otherwise, fair value PNL, short-term trading purpose, short-term trading. If not amortized cost, not fair value, then fair value, sorry, not amortized cost, not fair value PNL, then fair value OCI. Means held to maturity, but can be sold. For example, we have an intention for the maturity, but for any liquidity issue, we can sold it. Finally, one, investment equity instrument. Number two, investment debt instrument. Finally, one more, derivatives. That is also that can also financial asset if the condition favorable. Only one thing, fair value through PNL. You just remembered in this point. That's all, nothing else. That is a quick review of the financial asset. I must say one more thing about the financial asset. One more thing. About transaction cost. Transaction cost. If the financial asset at fair value PNL, then charge to profit and loss account immediately. If fair value OCI, add with financial asset, but subsequently automatically charged to the OCI. Amortized cost, add with financial asset, and amortize automatically, amortize subsequently. That is what about the financial asset. A quick matter, a quick. Do remember that these are not financial assets. These are not financial assets. These are not financial assets. Prepaid expense because not meeting the definition. Tax refunds. Why not? In prepaid expense, the contractual right to receive services, not the cash flow. Always remember, financial assets are these are where the contractual right to receive cash flow, not the services. Yes, we will discuss the difference. No, please don't talk right now. Focus on my lecture. At the time of break, then you must ask me whatever you want. But right now, focus on my lecture. I will discuss the difference. Don't worry. That is what the financial asset. Tax refund, not the financial asset, because this is not the contractual right to receive cash. It's a lawful right to receive cash. Okay, move on. A quick review of the financial asset. This one, financial liability. What are financial liability? Listen carefully. Number one, definition. Number one, definition. What's the definition? Number one, contractual obligation to pay cash. Contractual obligation to pay cash. All the derivatives under unfavorable condition. Under unfavorable conditions. Under unfavorable conditions. Unfavorable. Examples: for holder of forward futures, but situation is unfavorable. But do remember, in case of option, if we are writer, then the financial liability possible. In the case of holder, we are not in a position of the financial liability. We are only in a position in a favorable situation, because holder of the option pay the premium, not for disadvantage, only for advantage. Means not for unfavorable condition, only for favorable. That is what derivatives. That is what derivatives. Number second one, the most important matter, one of the most important about the financial liability. Contract with equity own instrument, but number of shares are unfavorable. Number of shares are unfavorable. Oh, sorry, unfavorable. Not sorry, not are variable. Number of shares are variable. If there is a contract where number of shares are variable, that means although it's a contract of equity on instrument, but this is financial liability. Number one. Furthermore, about the financial liability. Furthermore, when to recognize initial recognition, when become part of contract at fair value. Classification, profit and loss, amortized cost. Amortized cost by default. P&L in case of derivatives. In case of derivatives. In case of tradable, you have an intention for some trading of your financial liability. Amortized cost method by default. For example, loan payable. For example, issued bonds, all these things. Any issue cost, listen carefully. Any issue cost, any issue cost, fair value P&L, immediately charged to amortized cost, initial, deduct from financial liability and subsequently amortize. In case of financial asset, when we debited the transaction cost, that's add. But in financial liability, when debited, then the liability becomes reduced. Now, important thing, the equity instrument. The equity instrument. Listen carefully. The equity instrument. Some very important thing about the equity instrument. Whenever company issued the equity instrument, the characteristics of the equity instrument must be the holder of equity instrument having rights of residual interest. Residual interest means residual interest means remaining part, not the fixed part. Residual interest, which means rights are not fixed and having the exposure of fixed, sorry, having the exposure of risk. In substance, in economic reality, yes, any equity holder, if in reality, the equity holder exists, that's the rights of residual interest, not the fix. This is substance. And they are taking the risk of what? Risk of what? Risk of variation in the profitability, variation in the value. That's the basic aspect. Any issue cost adjust with equity, like share premium or retain earnings. That's a key thing. That's a basic thing that I have discussed with you. But the question is that the complication is that sometimes the complication, the company issued instrument by any name, by any name, by name of equity, by name of preference shares, by name of redeemable, whatever. but need to determine that that transaction is debt or equity. So accounting standard says this issue will resolve by definition and substance. Economic reality. By definition and substance. With that mindset, if the company issued the instrument and the holder issued the instrument and the holder, one side company, another side holder, must have to assess that two things. Number one, if the holder rights to get cash, so that means company obligation to pay cash. If this is the relationship, that is not equity instrument, because the theme of the equity, it's not about the fixed something related to the cash. First thing is about the related to cash. But if the company commit, listen carefully, this second thing is very important. If the company issued the instrument and commit to issue shares in future, so accounting standard says there is a test required. Test for what? Either something fixed about equity instrument or something variable about equity instrument. Once again, what economic reality? If we committed for fixed, this is the case, then we will say that here's the then we will say that the company should report the equity instrument like IFRS 2. In IFRS 2, company commits to the employee as a share option that, for example, at the end of the vesting period, if you stay here, if the market condition qualify, we will have to pay, sorry, we will have to issue a certain number of shares. That's why IFRS 2 equity instrument. But the situation is that if you issue the variable equity instrument, sorry, if you commit some variable equity instrument, variable means the holder having the right to get your shares, but it depends on some future value. They are not certain. That means this is not financial instrument. Oh, sorry, this is not equity instrument. Not equity instrument, but it's financial liability. Let's take an example. Let's take an example. Listen carefully. The company purchased a building 1st November 2019. Listen carefully. This example will be eye-opener for you people. 1st November 2019 with, for example, let's suppose I am a company, purchase a building from you. You and me decided $1 lakh building value. You and me decided. And my company have issued a commitment to you. What commitment? Commitment to you, huh? Holder, you are holder. That 1st March 2019, at 1st March 2019, whatever the value of market value of share, we will pay you, we will issue you the shares. I repeat, once moment, one moment. Once again. Building, A company, I am A company, purchased, fixed price 100,000. Fixed price. Listen here. I have commitment with you to issue the shares. And you are holder. Who you are? You are holder of this commitment. This commitment. Okay? This commitment. But the commitment is what? At 1st March 2020. Sorry. Purchase 1st November 2019. Huh? I have committed that 1st November 2019 to you that at 1st March 2019, whatever the market value of share, 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 I will give you the certain number of shares. If, let's suppose, now the market value $1, if the price decreases, number of share increases. If the price increases, number of share decreases. I have only one question with you. In this case, if you are holder, please carefully listen and answer my question. If you are holder of this contract, are you facing any risk? I have purchased the building from you, not hand over the cash, but I will provide you the shares. In future, if the shares value reduce, I will hand over more shares. But if the shares value up, you will get less shares. No. Very good. Good answer. The holder is not facing any risk. If the holder is not facing any risk, then how this company report this commitment as equity instrument? That's my accounting standard says, candidates, if the commitment is variable, it's variable, that we don't know that in future shares numbers are increase or decrease, then we will consider the instrument also in own equity instrument is liability. And if this is fixed, if I committed that I will hand over you 1,000 shares, that's all, then it's called equity instrument. That is the case. That is the case. You listen one thing carefully. Make up your mind accordingly. Last point. Make up your mind accordingly. Candidates, make up your mind. You are standing at reporting date 31st December 2019. The company have made a transaction 1st November 2019. And you are here deciding what to report. If the if the company issued, if the company made a contract where the number of shares issued in future, if it is fixed, then report as equity. If it's variable, then report as liability. That's all. That is what examiner expecting. That's a key point I have entered here. You can read it. This is an exam solution extract. I have extract from some one place. This handout already you have. I suggest you have to read it. It is not always the case. It is not always easy to distinguish between debt equity in entity's statement of financial position because instrument have both elements. IS 32 brings clarity, consistency in this matter. So classification based on principles rather than perception. First, you have to put the description of equity instrument. This statement is very important. You have to write if you need. IS 32 defines equity instrument any contract evidence residual interest in asset of entity after deducting liability is it must first establish that instrument is not liability before classified equity. Then two things you have to consider. Number one, number two. Number one, sorry. Number one, read it please. Financial instrument, equity instrument, if there is no obligation to deliver cash or financial asset another entity. If the instrument will maybe settle in the issuer's own equities. And you have to consider these points. Have you attached any dividend, fixed amount, whatever? So two things you have to consider. Either related to any commitment related to obligation to pay cash. And number two, fixed and variable test. You can read it accordingly. You will fix it. No issue at all. I have attached some examples here. It's easily you can understand it. I have attached it. I don't have enough time to read it completely. But you can read it and identify. This is more, don't go anywhere for this problem to identify equity or debts. This handout is more than enough. I have attached a question here, a P2 question. Read it. Please read it once. Heather discuss whether the following arrangement regarding shares of the CAVR should be treated as liability equity in the financial statement respect of issuing companies. CAVR, two class of shares, A and B. A, no issue about it. A is right. B shares are not mandatorily redeemable shares, but contain a call option. Call option means, okay, we, the company, either, hello, CAVR, a company, issued a shares and also have call option means already issued shares and also the holder to right holder means holder of option means right to buy the shares at a fixed price means you have issued the shares and also rights at buyback. Dividends are payable only B shares if and only if dividend had been paid the ordinary shares. Terms of B shares are such dividends are payable at a rate equal to that of ordinary shares. Dividend will be same as equity holder. Additionally, CAVR also issued options. Okay, this one is different. This is case one. This is case two. CAVR also issued options, gives counterparty right to buy fixed number of its B shares, fixed amount of this. Contract can be settled by issue of shares by CAVR. Discussion now about B shares. You can read it. You will write in this manner. Classification of CAVRs, B shares will be made by applying principle-based definition of equity and considering substance rather than legal. Substance relates to consideration contract terms of instrument. This is what knowledge. This is what case. The following facts are relevant here. Dividend are discretionary. Then they need only if paid to equity shares on which no obligation to pay dividend. Dividend B shares paid at same rate A shares. That is variable. No obligation because we are contract holder. We don't have an obligation, but maybe redeem or may not be redeemed. The above facts are demonstrate that this is equity instrument. That is how you will write the answer. In the case of share option, fixed for fixed test must be applied. If the amount of cash own equity shares deliver is variable, then contract in that instrument. However, contract is to be settled by CAVR issuing fixed number of equity instruments for fixed amount. According there, no variability of shares. Share option classified as equity instrument is equal to IFRS 2. Candidates, one more thing I wanted to say here. One important thing I wanted to say here. Have you ever studied the issuance of compound financial instrument? Yes, sir. Issuance of compound financial instrument. Compound instrument. We have already studied the compound instrument. Compound financial instrument. Issuance of compound financial instrument. Issuance of compound instrument. Okay. So company, what company says or committed? Company commitment is to redeem. Redeem means cash or convert into shares, that is fixed. That's why now this is called financial liability, because contractual obligation to pay cash. And this part now is split in two components: contractual obligation to pay cash, financial liability, and equity instrument, because commitment for fixed shares. I know you are very much champion. You are champion for what? How to split compound financial instrument. But here the championship is not about split the thing and just put the values. Here the championship is about why we are distinguished in this manner. And examiner has examined this point. Tell me why. This is a question of stand. Previous one, since last 2 days, we have engaged with this question, with the ethical matter as well. And there is a matter of the preference shares. I don't have time right now to discuss this matter, but I have attached the solution here. That is convertible. And here ask, what is the right accounting treatment? They have done wrong. Let's read it quick. 1st October exchange, CEO, finance director, each paid 2 million cash in exchange for preference shares. Okay, here CEO and finance director paid. It means the holder, the company, and the holder is here is the management, in exchange for preference shares from stand. So that means stand issued the preference shares to CEO and finance director. Provide cumulative dividend 7% per annum. Cumulative, have to pay. If not 1 year pay, we have to pay next year. These preference shares can either be converted fixed number of ordinary shares in 2 years time, or redeem at par same date. Either redeem or fixed number of shares, choice of holder. Choice of holder means choice of CEO and finance director. Finance director suggests the accountant that preference shares should be classified equity, because conversion fixed number of ordinary shares, fixed for fixed, and conversion is certain. Is this right? Answer me. Answer me, candidates. Is this right? I'm not discussing the lecture with the robots. I'm discussing with the human beings. So the answer, it's not simply no. You have to work out accordingly. That's why this is convertible. This one, all these things, including the matter of the covenant impact on gearing. If you wanted to put all the equity, that means equity will increases, gearing decreases. So this will also connect the performance measurement and ethical issue as well. Candidates, one last thing: own equity instrument and derivatives. I just say one thing. Derivatives. When I uh, discussed the matter of derivatives, I told you one thing. If you shoot the derivatives, always the cash is variable, but instrument is fixed. Cash is variable, but instrument is fixed. Don't mix the concept of own equity instrument derivative with the previous one that we have discussed. If I ask you that in this questions previous the concept, we will definitely issue the shares. That is called executory contracts that we discussed. But here we are not discussing the executory contract. This is the derivatives, but own equity instrument. If the law allowed, for example, you are a company, you are ICI, and your treasury department purchased a derivative of ICI. Most of the country is not allowed, but let's say legally allowed. So this this concept is not mixed with the above one. This concept is always with derivatives. In derivatives, by default, cash is variable and instrument issues is fixed. So do remember, if own equity instrument derivative contract, it's always financial liability if unfavorable, financial asset if favorable, always. And that is what the examiner has examined in December 2014. So in simplify, note it down somewhere. Although recorded is going on, derivative contract either with equity instrument, without own equity instrument, sorry, derivative contract with company own equity instrument or any other derivative, always the cash will be settled in variable and the number of instrument will fix. In case of favorable condition, that's financial asset, unfavorable condition, financial liability, and you can work out accordingly. That is what the point. One more thing, you can read it accordingly. That is contingent settlement candidates. And sir, is this concept connect with performance measurement? I have made notes. Yes. And this is for you people. This is another gift for you. Sir, how this aspect can be made, can be connect with performance measurement. That's examined already examined as previous. One more thing I need to discuss, the important point, financial asset impairment. Only one time that's already examined. A quick review of the financial asset impairment. Candidates, I hope that you have made a quick review and your concept now becomes settled related to the debt and equity instrument, whatever I have shared with you. Abbas, you can review my recorded lecture once again. Otherwise, if you have any issue, I will reply on the WhatsApp. Don't worry. Candidates, another important point, that is impairment of the financial asset. Listen carefully. A quick review about it. You ask me that own equity instrument derivatives. Listen carefully. One moment. You are an ICI. Let's suppose you are ICI, the company name ICI. You purchase a derivative of Forex. Okay. You purchase a derivatives of, let's suppose, gold. And you purchase a derivatives for your own company shares. Means futures, ICI purchase futures contract, option contracts of ICI own shares. That is what equity instrument derivatives. So never ever distinguish the derivatives with own equity instrument or other one. Okay, candidates. Actually, do remember one thing, derivative aspects will not be examined in very much detail in the SBR. If you really want to get what is derivative, then get my lectures of AFM. That is the part of the AFM. The detail of the AFM, what's about the derivatives in futures contract. Here the limited examine only the matter of the um, reporting. Okay, so now the point is about financial asset impairment. Okay, the financial asset impairment. Listen carefully. Make quick background. What is the meaning of the financial asset impairment? Listen carefully. Okay. Now, important thing. Bismillah. Financial asset impairment. Financial asset impairment. Number one. First of all, make up your mind. Financial asset investment in equity instrument. Financial asset derivatives. And we have classified in this manner financial asset investment in debts. DI debt instrument. Do remember that for these two cases, any impairment adjustment automatically adjusts with fair value. No extra working. No extra working. In fact, financial asset investment in debt instrument, fair value PNL, fair value OCI. That's automatically adjust accordingly. But actual complication is about the financial asset investment in debts and amortized cost method. That's a critical point. That's a critical point. Financial asset investment in debts, amortized cost method. That's a critical thing. Candidates try to focus here. Very important concept. Don't talk on the WhatsApp right now. Focus here. Financial asset investment in debts, amortized cost method. Example. For example, you are a bank and you have made a loan to me and you have booked loan receivable. of $100,000 for 3 years. For 3 years. You have made a loan to me for 3 years. That is a simple amortized cost method. Okay. So how normally first situation, all things are going well. So you will work out accordingly, now. Year end 1, opening balance 100,000. Then you will book interest income. That is 10%. Then interest receive 10%. And that's must be add less ending balance. So that's 10,000, add 10,000 receive, and year end value 100,000. Number 2, once again 100,000, then again 10,000, then again 10,000 plus minus 100,000. Third year 100,000, interest income book 100,000, you receive 10,000, and here 100,000, and finally all receive nil. This is the norm situation. This is the norm situation. Okay, one important thing. You have report 100,000 here as a financial asset. As a financial asset. At what expectations? Add the expectation that you will receive the all of your money, interest income, all of your money, interest, and principal at the end of the day with that expectation. You will get the money with that expectation. You must have to know one very important thing. If you are a bank, I am not the only one to whom you invested. You have made a complete portfolio where number of loans, where number of loans here, thousands of loans here. But IFRS 9 says that whenever you report the financial asset, financial asset, you have to develop an approach of impairment with respect to this complete portfolio. Then is there an expectation that some of your customer will default? Financial asset impairment, it's not about that someone will actually impair and you will report the loss. No. Financial asset, sorry, IFRS 9 says that you have to assess a futuristic approach, a proactive approach with the name of expected loss method. And that is called financial asset impairment. A very first day, you have to assess in your portfolio of loan how many of the customer expecting of the loss. Your concern is not right now how to assess. Your concern is that the assessment has made and you have to report it. So number one, this expected loss whatever you have made loss will split in two parts. If the severity is lower about the losses, that is called 12 months credit loss. And if the severity is higher, if it's called lifetime expected loss. So the question is expected loss, 12 months credit, lifetime expected. First, estimate the expected credit loss, expected loss. This estimation, number one, this one is A. Then you will report either this one, 12 months if severity is higher, or this one. Do remember that expected loss is based on the proactiveness. But sir, is it possible that out of the portfolio, one customer actual default, actual impair? Yes, it's possible. But hold it for the time being. Actual impairment. Hold it for the time being. The very important thing you need to consider that if not actually impair and you are just assessing, so one side you will record the loan receivable as a bank. Loan receivable debit, bank credit, one side. And another side, you will record like the allowance for doubtful debts, means income statement debit and allowance for expected loss credit. Means you will move as an allowance. Means this table will made accordingly, same way. If you are estimating 12 months if the severity is lower, estimating if severity is higher, the table will made accordingly. You just make an allowance. Your interest income will be work accordingly, no issue at all. But once actual impairment occur, then something other things going on. You have to work out. If examiner asks that what are the impairment indications, you have to work out accordingly. What are the indications of the impairment? Then you have to know that it's a forward looking approach. What is the meaning of the credit loss? What is lifetime? What is 12 months? You have to know that. You have to read accordingly. And this is what a figure. This is a very quick matter. Three-stage element. Credit loss. Stage one. Stage one means the severity is lower. That is called no significant risk. Stage one, less. How to report 12-month expected credit loss? And effective interest rate means the table of amortization as previous. Stage two, when you report stage two, credit risk is significant increase. You will record the loss lifetime expected. But do remember, in these two places, you will make the allowance and your table will work accordingly. But some objective evidence arise, actually happen. This is lifetime expected. But now your table become income on net basis. What does that mean? I will explain it. Candidates, here is an example. I will give you an example, a very comprehensive example. Then we will make a break. So please be with me. After that, I will make a break. I will explain accordingly. So be energetic, be motivated. Now we are working accordingly. Please read the question once. Once you read the question, this is a very comprehensive example. You will get the idea quickly. Inshallah, you will satisfied with that particular example. Your all concept will be clear, or ambiguity will be over. Inshallah. Do remember one point, either one time, at one time, either level 1, either level 2 or level 3. These are not working simultaneously. At one time, you are reporting either level 1, either level 2, either level 3. Okay, now I'm reading the question. On 1st January X2, 1st January X2, Dexter Lee PLC originated 5,500,000 sterling. It's classified as financial asset measured at amortized cost. Loan is fully repayable at the end of year 5. Means there is 4 years time between X2 1st January till X5. 2, 3, 4, 5. Effective interest rate 4%. Payable at the end of each year. On initial recognition, the loan as a low credit risk and the probability of default in the next 12 months is 1% with the lifetime expected credit loss. What does that mean? The company calculate the credit loss 125. From where it arises, leave it. Let's suppose that it's given. But the important point is that at first day, this is the first day, initial recognition, we are making an allowance like a receivable at 1%. So first we will work out at initial recognition. In initial recognition, there are 2 entries. Listen carefully. Initial recognition. Number 1, financial asset debit, bank credit. And you have made an allowance, impairment loss debit, loss allowance credit. That's so simple. Based on 12 months expected credit loss. I don't think so that till now you have any problem. This is what stage 1. And now you have reached at year 2. Definitely 1 year has gone. The situation become changed. 31st December X2, there has been no significant deterioration in credit quality. And the loan considered low credit risk. Probability of default increase 1.5%. Increase to 1.5%. You have already till 1%. Due to marginal increase credit risk borrower, lifetime expected credit loss 125. Now are standing at 31st December X2. 31st December X2. 1.5% of 125,000. That is equal to 1875. Out of that, 1250 previously recognized. So the difference 1250. Impairment loss adjustment. And we have made a same table. No change in interest income. That's effective interest rate. 20,000. So, sir, at that date, what we will report? Statement of financial positions. Statement of financial position, financial asset value. That's equals to 500,000. Allowance you have made, allowance. That's the total value of 1875. So 500,000 minus 1875, 498, 125. That's all. And the statement of financial position. Interest income, 20,000. Definitely. And allowance, total P&L charge, allowance, 1875 income statement. I don't think so that you have any problem till now. Please reply. It's so simple. Okay, now move on. Now move on. Now move on. You will definitely clear all these things. Now move on. 2000 X2 gone. You have published account. 31st December X3. There has been a significant deterioration in credit quality. No objective evidence. That means now we fall to step 2. This is step 2. No objective evidence, but we are in a position that the customer significantly deteriorate the credit quality. Expected credit loss over remaining life, 50,000. So what will happen? We have moved to step 1 to step 2. But in step 2, we will increase our impairment loss. That's 50,000 minus 1875. Previously recognized 48125. That's the P&L charge. But in the statement of financial position, financial asset 500,000 minus total allowance 50,000. 450,000. Income statement 48125. Expense. But income is still 20,000 as previous. Means amortization table is straight. No issue at all. Either step 1, either step 2. But candidate, last one. Do remember 31st December X3 gone. Remaining 2 years, huh? And at X5. 31st December X4. Evidence of loss event and loan defaults. And actual impairment loss estimated 125,000. This is what actual happened. 31st December X4. Do remember 1 year is still remain. Loan is classified stage 2. Impairment loss 75,000. till 31st December X4, we have put the income 20,000. But subsequently, that should be adjusted. But here the impairment loss is simple. We have reported the financial asset 500,000 minus 125,000. $375,000. Interest income statement charge 75,000. Income 20,000. No issue at all. But candidates, here the point. 2000 x 5, that is the challenging. Next year amortization table will make an interest income will be adjust accordingly. 500,000 minus 125 total allowance, then credit to income. That is the key point you have to consider always. If there is some objective evidence arise, you have to calculate the income on the basis of net of allowance basis. That is the point. That's all from my side. I cannot make more time. I cannot spend more time for IFRS 9 accordingly. Candidates, I strongly suggest that from your regular studies, you have to work out that how expected loss calculated. And that is very simple. Present value of expected shortfall. Because whatever the working we have made here, with that assumption that in question, expected shortfall given, that's 125,000. This is what present value of future shortfall. Shortfall means that the expected losses, expected amount that will not receive. Candidates, that is all from my side for IFRS 9. A little bit briefing and how to handle the situation. I have attached some more details. Oh, okay. You have to attempt the question of March 20 question 1D. Examiner have already examined March 20 question 1D. You have to work out accordingly. Must attempt, must. That is all from my side. I strongly suggest take a break. Then we will discuss more thing accordingly. 10 minutes break. Ten minutes break. After 10 minutes, I will discuss something about the leases. 10 minutes break. Take a 10 minutes break. Thank you. Hello, ji. Assalamu alaikum once again. Hello, hello. Are you people there? Please reply me on the WhatsApp about your presence. Come on. Bismillah Rahman Rahim once again. Okay, candidates, once again. There's a matter of just a moment. Okay. Class, there's a topic about accounting standard, that's the lease. And what the lease about? Lease is basically another contract, and contract between two parties. 1 minute. Yes. Okay. IFRS 16, a limited thing we can work out accordingly. Lease lease is basically a contract between two parties where one party convey the right to the another party. Huh? That is the lessor and the lessee. Important point is that lease is you have to identify that the contract must be a lease contract. Number one, you have to identify that lease is a the contract is a lease contract with the component of one party that you convey the right to use asset to the another party in exchange for consideration. So you must have to identify in the contract that this contract is a lease, even though it's not mentioned the term lease, still the contract will be the lease. Now, important point is that you have to work out accordingly. Three things important in this particular standard. Number one, identify the lease contract. We are going to make a quick briefing of three things. Identify the lease contract. Number two, reporting of lessee and lessor. Number three, sale and lease back. So when two things is very simple here. If I say that lesser accounting, so before account for the lease accounting, lesser must have to identify that either the lease as a finance lease or operating lease. In the finance lease, where we can say that the risk and reward means major benefit transfer to lessee. Number one. and you have to assess this point, how to risk or reward transfer to the lessee. Number two, the accounting is that what are the asset must be de-recognized. Asset must be de-recognized. And an account called lease receivable must be recognized. And there should be some amortization schedule. So actual accounting is about the lease accounting with an amortization schedule. In case of operating lease, which means risk and reward belongs to lesser. And I must say, just like rental arrangement, just like rental arrangement. And if you think that it's just like rental arrangement of any asset, like property, plant, equipment, whatever. So asset as per IAS 16, cost or revaluation model. Any rental income must be recognized on a straight line basis. That's all. That is what the accounting. We are not here to discuss about the numbers. You can just make a good go through the notes I am giving to you. But what about the lesser accounting? Sorry, lessee accounting. About lessee accounting, you have been studying since FR. Huh? It's very simple. It's very simple. About the lessee accounting, one moment. Okay, lessee accounting, irrespectively, irrespectively, for long dated or short dated, sorry, irrespectively, that lesser account for finance and operating days. The reporting of the lessee is still in one manner by name of right of use asset. Only one manner. Right of use asset. Either long dated asset or short dated. Right of use asset. Along with lease obligation. But do remember, first need to calculate the lease obligation. Then you will calculate the right of use asset. Lease obligation includes fixed and variable rentals, fixed and variable rentals, and any other amount expected to receive from lessee. It's very simple. Right of use asset you can work out as per IS 16, means cost or revaluation model. It's very simple. A quick briefing, you can read it accordingly in this manner. But candidates, the very important thing I wanted to discuss with you, that is about identification of the lease. This is a very important concept. An examiner can twist you. Listen here. This topic. This is a very critical topic. Although accounting is second point, the first point is that determine that is the contract lease, is the contract lease. There are two particular components for any particular lease contract, and we will consider that contract as a lease. And what are these two? Number one, whatever about the asset of the lease, the asset must be identified. Number one, plus right to control the use of identify asset. Do remember that there are two parties in the contract, lessor and lessee. But this determination of the contract, either lease or not, always with viewpoint of lessee, that we have to identify that either the lessor convey the right to the lessee its identified asset, and is the lessee control the asset or not. That is the key point. That is the key point. Now I'm giving you some basic examples. Listen here, you can read it accordingly. Some basic examples. Listen careful the examples. The examples. Examples. For example, I'm a company. For example, I'm a teacher. For example, I'm a teacher and I wanted 2 rooms for teaching purpose. I'm a teacher. So I have a meeting with you. You right now the term seller and me who are interested to buy your services of the rooms, that's buyer. I have used the term you and me, seller buyer, not the lease, because until unless the contract meets the definition, we cannot say that IFRS 16 will open as a lease contract. Okay, now you, the seller, have a room, have a building, and this building has 6 rooms. 1, 2, 3, 4, 5, 6. And you and me are meeting and finalizing the matter, some matter. We have finally decided that you seller convey me the right to use these two rooms, 1 and 2. These two rooms. Although your building have 6 rooms, but these two rooms have identified for 4 years. For 4 years. So this is a very simple example where the contract identified the asset. Number 1. Number 2, the buyer, that's me, will use these two rooms for my teaching purpose without your interference. Without your interference. Without your involvement. So that means room are identified and directions belongs to buyer. So then I will say that this contract is lease because assets identified and the customer have a right to direct the use to use the asset. Lekin but one very important thing for more clarification. Let's suppose this is example 1. Example 2, same 1, 2, 3, 4, 5, 6. You are seller and buyer. You and me have decided that this is the building. For 4 years, you have given me to use 2 rooms. But seller says that with my control, that you are a seller, with my control, you can use 2 rooms, first 2. But with my consent, I can adjust the contract anytime and replace 1 or 2 with 3, 4 or 5, 6 or 4, 3 or 5, 2. It's total consent of the seller. Buyer will only obey. Means for the sake of the benefit, seller can change this. If this is the case, that's called asset is not identified. Then this transaction will not report according to the IFRS 16 leases. No right of use asset, no lease receivables. It's a simple rental arrangements by conceptual framework, basic expense and income, not IFRS 16. Yes, with respect to example 1, listen carefully. With respect to example 1, if the asset identified but seller restrict me not to use for any illegal purpose. For example, seller restrict that you will teach the course but not teach any anti-political items, any anti-political issues. These rooms will not use for the brainwashing for terrorism activities. I'm example. It's just give an example. This is what only to make a directions, but not restricting to the buyer. So candidates, 2 components must be there. Identified asset and right to control the things. Examiner can exactly example for this. For example, I'm also giving 2 examples to you. For example, you are a transporter. You have a fleet of cars, 1, 2, 3, 4, 5, 6, or buses. You are a transport. I'm a company. There is an agreement between you and me that these two buses, bus number 2 and bus number 6, will hand over to you for 4 years. Total life 20 years for 4 years. These two buses. Exactly these two buses. And we will hand over to you. But if in that case, if bus number 2 or car number 2 and 6 have any problem or trouble, then we will replace with anyone. Otherwise, you will continue. So condition 1, 2 and 6 specifically to you. But if in that case there is some problem, for example, repair maintenance, then we replace with the car. Otherwise, smoothly 2 and 6. And the company will not use 2 and 6 car for any illegal purpose. Answer me. Is the asset identified? Yes or no? Is the asset identified? Yes, asset is identified. Although restrict for illegal use, although for repair, maintenance, the replacement. But majority term, it's yes. No, right now we are not talking about operating or finance lease. First thing is that the contract is lease or not. Then based on contract, if it's become lesser, definitely if IFRS 16 open, this is lesser, this is less. Then lesser will consider based on above discussion. That's the score about transfer to the company or not. If yes, then operating lease. If not, that finance lease. And lessee will account for the right of the asset. So candidates, examiner can examine. These are the illustration of accounting standard. Examiner can examine like these matter. I have attached some examples with this one. This is the comprehensive examples. Don't go there anywhere. I have attached all the examples here. You just read it and inshallah you will get the matter. Sale and lease back. Another point. Sale and lease back candidates. Sale and lease back. In IFRS 15, there is a concept of sale and lease back. Sale and lease back basically a financing arrangement. A financing arrangement where a company must say that we are going to sell one of asset, sale of one of asset, and immediately lease back. How to account for this? A very quick review about it. Sale and lease back. Number one, the first thing you have to identify that. The first thing you have to identify that. Lease back is a secondary point. First thing is that the lease? Sorry, is that the sale? And for sale, you have to work out for or you have to refer for IFRS 15. That is sale means have you completed the performance obligation? Have you satisfied the performance obligation? That means control of the asset and ability to obtain substantial all remaining benefit belongs to the buyer. If yes, sorry, if no, if it's not sale, but the contract name is sale and lease back, that's simple, a loan arrangement. If sale and lease back, but IFRS 15 condition not meet. That's simple loan arrangement. And loan arrangement means lessee here receive the amount and called liability. Report the liability. Asset still continue to recognize. And whatever the amount paid by the lessor, it's not possible to recognize any asset, but he has to book the loan receivable. Loan receivable debit bank card. You can make a screenshot here. You can make a screenshot. I will hand over to you. Don't worry about it. That's a key point. Okay. But the point is that if the transfer of sale of asset, performance obligation satisfied, yes, yes, that's an important point. So that means you have sold but lease back. If yes, do you know that what does that mean? It means that if you sell the asset before the sale you were owner, but you still use the asset, it means you are now become lessee. It simple means the journey become end from owner but convert to lessee. Owner to lessee. Your non-current asset must be de-recognized with this entry. Bank debit, right of use asset debit, machine credit, lease liability credit, any gain or loss should be recognized. But do remember that and lesser recognized as per I-16. IFRS 16 always apply in this case as operating lease. Always. Transaction should be non-current asset debit bank credit. Do remember that. Do remember that. The right of use asset should be recorded in this formula. Whatever the present value of lease payment divided by fair value of lease asset, multiply by carrying amount of lease. Moreover, moreover, in the case of transfer of asset, you have to consider that either transaction at sale of sale at fair value, no issue at all. Previously, whatever we have discussed. If it's less than fair value, whatever the amount you lower receive will be considered as prepayment. And if it's higher than fair value, whatever the extra amount we will receive, for example, the fair value of asset 1 lakh and it's equal to fair value, no issue. But sale and lease back at 98,000. So that means this reduced 2,000 as a prepayment. And what if at fair value 100,000, but we have made transaction 1 lakh 2,000. So additional finance must be as a liability. So do remember whenever you are working for right of use asset, in this case, That should be add on, but this should be less. Candidate, this is what about the sale and lease back. I will hand over you the slides, don't worry. You can read it accordingly. Examiner has examined this question one time. I will, whenever I will share you, I will mention the exam questionnaire. Don't worry. That is what a quick review of the IFRS 16 candidates. That is what the quick review of IFRS 16. Candidates, we have limited time and we are going to discuss some important aspect related to this part before entering the next element. Candidates, we discussed the performance measurement report, aspect previously. I know that I haven't shared uh, I haven't shared the performance measurement question. I will share accordingly, don't worry. Uh, but you need to consider one important point. Don't worry about that. The statement related to right of use asset. I will reply you on the WhatsApp. But focus first of all here. In the case of more than fair value, less than fair value, you need to adjust it. Actually, this formula will need to adjust. Listen. If less than fair value, if less than fair value, whatever the amount lower received, we have to minus. If in that case greater than fair value, whatever the amount we have received more, that should be added. That is the point. Move on. Candidates, listen carefully. SBR performance measurement 2. I will hand over this particular handout to you as well. I wanted to discuss one important thing with you, a limited discussion. Whatever that performance measurement I have shared with you, that was about the financial performance measurement. Yes, financial performance measurement based on the ratios and traditional method. Based on traditional method. But here, some more concept related to alternative performance measurement. First of all, for alternative performance measurement, you people must have to read the notes and one ACCA article and the sequence of the past paper. Don't go anywhere. Just it. Now, what is APM? APM means alternative performance measurement. Alternative performance measurement. Alternative performance measurement means Actually, listen carefully. Listen carefully. For example, you are the shareholder of my company, or you are debt holder of my company. Listen carefully. So your amount is here, equity, debts. When I publish my accounts, and you people wanted to know that in the published accounts, how our finance are invested, that's asset, and generating return, that is profit. For example, PBIT, and moreover profit after tax. So feel that you are observing the financial statement, but the question is that you know very well this is your amount, but I am showing you that your amount invested this asset. Asset means future benefit, and utilizing this asset generating the profit. But the question is that is this sorry, and you know very well that this all are this all are based on IFRS. IFRS means some standards, international accounting standard. And even so, you trust on the IFRS, number one. And even you are not shareholder, you are potential shareholders. Even though you are referring this financial statement that based on this IFRS statement, can I invest on it? So you said that yes, this is accounting standard, some authentic standards from which these accounts are prepared and audited as well. Audited as well. But ask yourself, but ask yourself that is this information enough for you? Is this information enough for you? For the sake of the provider of the finance or the potential shareholders? The answer is no. That as a user of the financial statement, this is not enough the financial statement and the disclosure. That's why in the real world, some alternative performance measurement also published. So the reason of the topic I have discussed with you, but there are some issues as well related to this APM, issues as well. So what do you prepare? What preparation required? APM, why? APM, what? And APM limitations. Why APM I have discussed with you. What alternative performance measurement? These are alternative performance measurement. Means one of the example that is called earning before interest, tax, depreciation, amortization. That we are in the other than financial statement. Do remember that APM, there is no guideline about the APM related to IFRS. There is no guideline. I, whatever the IFRS we study, that's over. APM means These are the performance indicators other than IFRS. So one of the example of APM, that is earning before interest, tax, depreciation, amortization. No. You required, number one, the background. Number two, you also know how to calculate, but calculation is no matter. If I say that earning before interest, tax, depreciation, amortization, so this is a simple formula. You need to work out accordingly as well. And limitation as well. Advantages, disadvantages. Number one, same case, EVA, like F5 you discussed, EVA, economic value addition, residual income. And what they suggest for APM, you have to calculate and publish. Benchmarking, benchmarking. But these are the matters, but they are a limitation. First of all, these are not standardized. These are not standardized candidates. These are not standardized. It's not standardized means every company, every society, every group of companies, that industry make their own performance measurement aspect. That is what the issue of the APM. So I strongly suggest that you have to read these handout and moreover attempt these questions accordingly. It's very simple with the following sequence. These are the financial indicators, but in the another manner. One time, examiner also asked with the ethical aspect as well. One thing. Furthermore, candidates, furthermore, in this handout, I have attached some more thing of the book related to, is the financial performance enough? No. Some non-financial matters as well important, non-financial indicators. And these non-financial indicators like balance scorecard, you studied F5, balance scorecard, non-financials, integrated reporting, management commentary. So I strongly suggest that you have to read this, and whatever the question I have shared with you, oh sorry, the questions and matters I have mentioned above, you have to work out accordingly. So that is what the performance measurement part 2, I will share the questionnaires as well accordingly. Candidates, furthermore, two things quickly. I mean, I will work in these two matters as max as possible. The important point related to this, I will share you two things about the conceptual framework. Number one, the document of the conceptual framework related to book. And number two, the question bank. Number one, the important thing is that conceptual framework. Do remember that the conceptual framework that will examine, that's 2020. I mean 2018 applicable conceptual framework, new one. New one. Only new conceptual framework. Candidates, as you know that, listen carefully. International Accounting Standard Board has two projects. Number one, making of IS and IFRS. And another one, that is conceptual framework. Two different projects. These are the ISB project. although, yes, we accept that this is all about numbers figure, but behind the number, the objective is, the reporting objective is qualitative. You must have to bear in your mind. Although it's about the numbers, but the reporting objective is qualitative. Qualitative means if you are the financial statement user, what do you want from the financial statement? The financial statement should be reliable. So what is the meaning of reliability? It's quantitative or qualitative? True and fair view, transparent, with ethical consideration, integrity, objectivity. What are these? These are known as candidates. That's qualitative. So conceptual framework establish the principle behind the accounting standard reporting. Number one. Number two, the principles of reporting of accounting and reporting. For example, asset, liability, revenue, expense, equity definitions. Going concern, accrual concept, matching concept. By the way, do remember that the definition of asset liability have revised, that have revised. But do remember that I'm giving you a very important thing. Very important. If I say that property, plant, equipment, IS 16. So property, plant, equipment is asset. So the basic principle of conceptual framework must have to met. That property, plant, equipment under, sorry, property, plant, equipment is a tangible asset, but tangible is second point. First of all, asset. IS 38, IS 40, that must obey the asset definition. Now, for your information, asset and liability definitions have changed, but now conceptual framework has revised. But amazing point is that accounting standard haven't incorporated the things of the conceptual framework. You must not do this thing, huh? You can for example, if there's a question about the IS 16 and you are describing that IS 16 recognition criteria, that is called control and all these things. But you cannot refer right now the conceptual framework. For example, conceptual framework says that ignore probable. One example. But IS 16 says that probable. What is the definition of asset? Definition of asset, controlled by entity from which the future economic benefit is probable, less certain. But here, new description of asset that you have to assess the certain matter, not probable. So conceptual framework revise the definition, but not about the property, plant, equipment, IS 40, financial asset, all these things. So you have to read it accordingly. And I must say that these are the backgrounds. You can read it accordingly. I must say that obey this one. There are 8 chapters about the conceptual framework. Whatever I have discussed, that you can connect with the objective, then the qualitative characteristics, Then what include the financial statement normally, elements of financial statement, what the recognition, derecognition criteria, how to measure, present, and concept of capital and capital maintenance. So you can read it accordingly. I've also attached the question as well with this document as well. So this is what a quick review about the conceptual framework. This is the current development. Examiner, regular example. I have attached a question of fill in this handout. Listen carefully. Don't refer. Sorry. In fact, I've also mentioned the cryptocurrency in this handout. How to account for the cryptocurrency. No, you don't refer the new definition. You don't refer the new definition. Listen carefully here. Candidates, wait a minute. Wait a minute. You will not refer because the definition of IFRS, the definition in conceptual framework change, but not with IS 16. Listen here. One moment, please. Listen here. The book's particular mention. Here is the game. What is the definition of property plant equipment? Property plant equipment recognize probable that asset future economic benefit. Probable, still probable. But what the new definition? The revised conceptual framework says that elements are recognized if the relevant information is faithful. Relevant means probable, eliminate. The recognition criteria 16 and most of the IFRS IS differ from the above because they have based on previous version of conceptual framework, not updated when the conceptual framework. So conceptual framework do not override the requirement of IFRS. And the recognition of property plant equipment therefore determined by the reference of the I-16. Is that clear, Hasib Saab? Mr. Hasib, is that clear? And all of you must make it clear. That's why I have opened the book here and refer to you. That is the point. So that is the point, clear? Don't refer, but you have to read it accordingly, whatever I have mentioned here with these two documents. This is more than enough. I have mentioned the cryptocurrency as well. Do remember, if I ask you that, if there is no guideline, if I ask you that, if there is no guideline to you people about any accounting entry, for example, rent expense, there is no guideline of the accounting standard, then what we will use, how we will report, definitely according to the conceptual framework. Candidates, till now, there is no guideline related to cryptocurrency. That is the fact. There is no guideline about the cryptocurrency still now. That's why the only relevant point of the cryptocurrency is the framework. Examiner can ask you in this manner. Book mention that. Yes, this one. The finance director of AFCO suggested that invest in cryptocurrencies. That can be part of the current development as a part of its investment strategy. Board understands what cryptocurrencies are, but has asked the finance director to explain what they would be presented in the financial statement. Finance director stated that they should be considered as financial asset, but unsure the consistent with IFRS and framework. The examiner examined this one time, but not available. Questions are not available. What we can say that about this cryptocurrency, about the cryptocurrency, one by one. Cryptocurrency has no physical substance. So we can discuss the matter of IS 38. They have identified they are non-monetary. In conceptual framework, investment appear to meet the definition of asset. These are the discussion. The cryptocurrency can be accounted for as a financial asset if for the trading purpose, no issue at all. Yes, you can read it. One of the purpose of conceptual framework is to assess, prepare the financial statement, not the standard. Yes, here. If there is a question about it, read this question. What is the question about? Cryptocurrency is a digital currencies operate independently of a central bank. There was well-known cryptocurrency, the Bitcoin. Some businesses are not accepted Bitcoin now accepted Bitcoins. The price of one Bitcoin 20 in 2013 rose to $20,000. Their fluctuation is very higher. If you are discussing the matter of, listen carefully what I'm saying that 1 minute. If you are discussing the concept of the cryptocurrency, you must mention that there are too much fluctuations. If we put at fair value through PNL, then our financials will be highly volatile. Like this, 2013, $20, now $20,000. Highly volatile. Investor can earn large return to buy Bitcoins on the exchange when the quoted price low, selling them exchange when the quoted price rise. Cryptocurrency like Bitcoin have proved problematic regards to financial reporting because they do not fall within the scope of issues of IFRS. As such, preparer of the financial statement must use conceptual framework to devise accounting treatment and provide useful information of the financial statement. Using the conceptual framework, discuss this matter. So you can fill this matter accordingly, but also refer the conceptual framework matters. Also the conceptual framework matter. Like this. Especially for this, Last statement, with the value of Bitcoin highly volatile, that value is likely to be expected for the short-term sale. As such, would seem that reporting gain loss P&L will provide most relevant information to the economic performance. In conclusion, by applying conceptual framework, it would be seen that appropriate treatment of investment in bitcoins would be measured to fair value, reporting that and present the gain or loss in the P&L. But do remember, I strongly suggest if you report the Bitcoin at fair value through P&L, you also mention that are the company's accounts will be very much volatile, and the user of the financial statement not not perceiving the consistency in the accounts. So that is it. This is not, there is no conclusion. This is not the point, the conclusion. That is about of your discussion, your knowledge. So candidates, that is what about the conceptual framework, how you will work out accordingly. Uh, I I wanted that I want to spend some time related to IFRS 15, but I've already told you that uh, I will extend the session for 25-30 minutes, 20-25 minutes. Now I'm going to discuss the IFRS 15. I think so that let's take um, a quick break of a short break of 5 minutes. Just take a 5 minutes break. I will discuss a quick points about IFRS 15. Let's take a 5 minutes break. Let's take a 5 minute break. Thank you. Okay, candidates, come on. Now it's time to move. A quick review of the IFRS 15 and moreover, a quick review of IFRS 15 and final points for the remaining 10 to 12 days. What do you need to do? And you people are asking, sir, what are important? This is what a very innocent question from your side. In fact, identify these points that what are the hot issues and what will examine. If anybody knows that, then exactly the limited things need to study accordingly. So instead of that, to identify the things that what will examine, it's much better that you must have to review quick briefings of the syllabus, briefly review of the syllabus, as well as moreover focus on the practice as much as possible, whatever the direction I have provided with you in that matter. Okay, I at last I will uh, discuss the matter about the. Just give me 15 minutes of a quick review of the IFRS 15. Number one, candidates, listen carefully. IFRS 15, IFRS 15, IFRS 15, revenue from contracts with the customer. Number one, the very important thing that IFRS 15, what is about the IFRS 15? That is the revenue. That is about the revenue. Do remember the most important thing. The only income that generate from the revenue is under the scope of IFRS 15. In the income statement, income can be uh, income can income exist not necessarily only under the umbrella of revenue. For example, interest income is also income. For example, sale of non-current asset also income. Dividend income is also income. But under the umbrella of income, only the revenue which arise from ordinary activity of business under the scope of IFRS 15. And only this matter, that's is this income under IFRS 15 or not, already examined in September 18, question 3. You have to work out accordingly. And also specimen 2, question A1. That you need to distinguish that is this under the scope of IFRS 15 or not. So it's not only about the 5-step model. This is also the critical thing. Is this income under the scope of IFRS 15 or not? You have to attempt accordingly. Furthermore, yes, if the income under the scope of IFRS 15, then I must say, then I must say, then we will use IFRS 15. That is called IFRS 15 revenue from customer contract, whatever. And you have to work out revenue, number one, with this 5 steps. So not necessarily the examiner examine the complete 5 steps. Maybe any limited 1 step you can work out. The first very important thing is identify the contract with the customer. Once you identify the contract, then move on next 4 points. If these conditions of contracts not meets, then the contract not considered as revenue. And in that case, whatever the amount, if you have received, record as a liability, not income. So number one, the very important thing, a contract that is an agreement between two parties creates rights and obligation. And the contract has these components. Number one, both parties, that's seller and buyer. Our position as a seller, huh? But seller, buyer both approve the contract. Each party rights are identified. Payment terms are identified. The contract are commercial terms. Commercial terms. Do remember, this is the commercial terms. I'm giving you one example. Listen carefully. Listen carefully. For example, just before the year end, the director have made a transaction, have made a transaction with a supplier, with a supplier. For example, I am Toyota. For example, I am Toyota, and I am the director of Toyota. Director of Toyota. Before the year end, my intention to exaggerate the sales. I have made sales to a supplier for 100 cars, and I have sold the cars to the supplier with a very nominal terms. I mean, abnormal terms, not equal to the market. The price equal to the supplier deliver the entry, deliver the raw material. Means raw material price and the sales price both are same. Normally I've sold the car 2 million rupees, but here I have reduced the price to 1.5 million. And this 1.5 million, it's my cost. Revenue and cost, in revenue minus cost, zero profit. With special term with the supplier. If this transaction has made, that means this is no commercial substance. Which means that there is no net inflows. There is no business terms. This is only for the sake of exaggeration of the sales. This is unethical, maybe illegal. And one very important thing, the probable. If on credit sales, that should be probable to collect the consideration from the customer ability intention to pay. If we made a credit sales, if we made a credit sales at the time of sale, not after the sale, at the time of sale, it must be probable that amount will receive from the customer. If it's not probable, we cannot record the sales. Candidates, what I'm saying, listen carefully, don't make mistake. At the time of transaction, amount expected to receive must be probable. If at the time of transaction, the the customer, the amount from customer is not probable, then we cannot make that transaction as sales. But I'm not saying that I've sold it, but in future after 15 days, the there are some bankruptcy related to the customer. Not at that date. At what date? At the time of transaction. An examiner have already examined this point. The collection of the amount of consideration to which entity entitled is probable. Examiner has examined this question. Minku. That's very much important. So this is not only about just the list you have to make. You have to work out critically all the things. Identify the performance obligation. This is where the performance obligations more than one. That is, for example, goods plus services or distinct of goods and services. So you have to identify the goods and services. For example, Toyota is going to sell the goods plus 3 years repair maintenance services. Determine the transaction price. Here, the most important thing, the transaction price, the variable consideration. For example, transaction made of the sales. Sales on credit. Fixed price and variable price. The variable are different categories. For example, bonus. For example, incentives. For example, errors. For example, I have made sales to you a machine. The committed price, fixed price of 100,000, fixed price of 100,000, plus the variable price that if the machine will not make error under 5,000, that you will make the payment to me some variable amount. For example, 100,000 plus 5,000. This is variable. A lot of things. Variable means the price of collection is uncertain. Is this the price of credit sales? Accounting standard says the variable consideration at the transaction date, you have to assess the variable consideration matter. We have to assess. If it is highly probable that the reversal it's not occur, means reversal of not occur, the variable, the conditions on which the transaction is based, that's highly probable that mistake will not occur, that reversal not occur. Reversal means brighter chances the condition will meet. Then you have to put with the sale transaction. Do remember that. Don't make mistake. Here the students make mistake that we have to put the probabilities. No probabilities. You have to be one-sided. You have to mark my words. One-sided. Either variable conditions meet or conditions not meet. If the brighter chances to meet the variable condition, then put it. Otherwise, ignore. Then allocate the transaction price according to fourth one. Allocate the transaction price according to the performance obligation. And the last point, the very much revenue recognize at one point or over the period. For example, listen carefully. You must have to remember this point accordingly. For example,
Contract 1st January 2019. But contract for 4 years. 1, 2, 3, 4. The question is that should I recognize the revenue, recognize 4th year or over the 4 years? 1 point this, over the period this. So the important point, you have to remember that point. I have made a rule for this. You can easily work out accordingly. Number one, at point in time, like retail stores, retail say superstores, over the period construction. What accounting standard says? Accounting standard says you have to assess the over the period of time first. That is the principle of C. I have made a principle of C. Read it. Whenever examiner asks you should to determine that revenue should be recognized over the period, yeah, one time. This is very technical. First of all, you have to assess that either over the period of time, assessment of the over the period of time. If not over the period of time, then apply at the end of the day one period of time. Accounting standard says when we call that over the period, when meeting any one condition, any one. For example, C. C means simultaneously receive and consume. For example, ACCA have made a contract with me, and at this moment of time, simultaneously customer, that ACCA or you, receiving the services and consuming the services. So I can recognize the revenue over the period, maintenance, like maintenance contract, simultaneously receive and consume. Otherwise, for example, I am a constructor and you are the customer. I'm a, I am providing services to you. What services? That I will build a building for you. So as the times goes on, for example, project 4 years, as the time goes on, 1 year has gone. So 1 year, I have done 20% of the work. So that means 20% of work enhance the asset, means asset has now become enhanced, constructed, and that control, that customer controls, means I am providing the services of building construction. As the times goes on, the control hand over to you. That means work in process, factory building. Enhance the asset, that customer control, that you control the building, and over the period of time, asset enhance. So if the contract is like this, that asset is enhancing over the period, like construction contracts, then over the period of time. And finally, either simultaneously receive or consume, either enhance the asset over the period of time, or number three, there is no A stand for alternative use. For example, I am the manufacturer of, I am a manufacturer of specialized machineries. So specialized machineries means you you have ordered me some customized machines. So I am making the machine which you don't have, which any alternate, there is no alternative use. No alternative use. Means other than yours, there is no usage of the machine. So if any of three conditions meet, then we will work out the over the period of time. If not meeting the over the period of time, then we will wait for end of the day. Then we will recognize the 100% revenue over this. Candidates, that is all over from my side. In this 15 hours, whatever I can do, I have delivered to you. In last 2 to 3 minutes, I'm just saying that what you should do last 15 days. Sorry, last, in fact, 10 to 12 days. Last 10 to 12 days. I must say, you will have to make the strategy like this. Listen carefully. Last 10 days. Three things you have to make a daily plan accordingly. Number one, quick briefing of syllabus area. You have to split your syllabus accordingly. That's I have already discussed with you. IAS, IFRS. Group accounts, other standards, performance measurement, conceptual framework. And definitely ethics is integrated part, no? Integrated part. Conceptual framework and current development. I will add a current development video when Tuesday or Wednesday. Don't worry. That will take hardly 1 hour, not more than that. Candidates, these are the things. Quick briefing of the syllabus. You have to split your program accordingly. You can split the thing accordingly. Less extensive, more extensive. And do remember, nothing the standard having low priorities. Any standard can be examined. You know that last time examiner integrate three things in one question of 25 marks. IFRS for SME, performance measurement, conceptual frameworks. Integrate 25 marks question. So all standards are equalized. And please don't waste your time by asking these questions. What are the hot topics? What are the current topics? Yes, for group accounts, you can make a sequence like studied right now. Number one, whatever the sequence I have made with the group accounts, follow this. Yes, less priority is cash flow in the group accounts and less priority forex. But still, foreign subsidy cash flow can examine on the performance measurement. Foreign subsidy, other than foreign subsidy, IS 21, other parts can be examined. But don't ignore it. But you must have you must have a knowledge about it, huh? Don't spend more time, but have a knowledge about these topics. For SME, you can avoid it. But I can say that. Nobody can say that. What are the hot topics? Number one, you have to split 10 days for these topics and quick briefing of the syllabus areas. Number one. Number two, last one. Simulate the question. Simulate means simulate the question SBR. Only focus SBR past papers plus specimens. Whenever you attempt any question, simulate. Simulate means assume that you are sitting in the examination hall. If you don't have time, at least make up bullet points and follow my instructions. The, you have to follow this, nothing else. Furthermore, the most motivating factor for your success is that 50% still chance that you will qualify the paper. Is a huge point. Be positive. Be positive. The most important thing. You must be very much positive. You must have to be with me on the WhatsApp, on my regularly, also like my Facebook page of onlinelecturers.com, and follow my YouTube channel. I will add more videos accordingly, including current development and 2 or 3 more things. Whatever you require from my side, do ask me, and avoid unnecessary discussion on the group. Relevant discussions. Ask me. I'm with you till the exam date. And please make a constructive feedback on the platform and on the WhatsApp about the session I have made. I have put my maximum effort to deliver you about the bridging the gap between examiner expectations and your performance. You can ask me any question. I put my maximum efforts accordingly, whatever I can done. These 15 hours. YouTube channel address mentioning by this. Thank you very much. Yes, I will share you all the material on the WhatsApp group, all the material. I will take a dinner and take, and after that. Jazakallah khair. You can contact me for SBR matter, for any FM matter, for any AFM matter. We can provide you best support for any time. For FM, for AFM, for SBR, these are my expertise. Any more thing you wanted to ask, do reply, do coordinate me on the WhatsApp. I can put maximum effort for the replies or making the things on the channels like YouTube or Facebook accordingly. But do simulate the exams. Do simulate the exams. And don't worry about that. The answer will be right or wrong. You will qualify the SBR exams if you put your efforts, even though conclusion will wrong. Even though calculations wrong. Okay, candidates, thank you very much. I will also miss your you people like this type of audience. We really enjoy with your side. Thank you very much. I also miss you all of you. You can contact me on the WhatsApp about these subjects SBR, AFM, FM. Thank you very much. Take care a lot. Uh, no, for conceptual only. I've already told you, Tajwar, in IS 16, don't refer or any other, no accounting standard have updated the conceptual framework asset matter. Only the conceptual framework mentioned the new definition. Okay, I will try my best for all. My notes include the sustainability. Include sustainability. If you required more thing, do reply me. My notes include sustainability. No account, no accounting standard have incorporated or impacted the new consolidated conceptual framework asset liability definitions. For asset liability definitions, no accounting standard not yet till now adopted any definition matter. Okay, thank you very much. Thank you. Thank you very much. Jazakallah khair. Jazakallah khair. Assalamu alaikum. Lessee accounting for lesser accounting. We will try our best. Thank you very much. Take care of it. Lessee and lesser classification. Only lesser will classify the lease as operating on finance. The lessee will account for only right of use asset. Entry for lessee or lesser. Lessee accounting, right of use asset, debit, liability credit, or any payment made to then cash credit. I'm not getting. Okay, thank you. About the time allocation, I have already discussed the matter in the lecture one. Normally, do remember, in whenever you're sitting in the examination hall for SBR, try to save your time for section A. Try to save your time for section A. Candidates, try to save your time for section A, because section A is comparatively predictable. Group accounts, ethics matter, and normally what happens, 1.8 uh, minutes for each mark. So for group accounts, I strongly suggest that for group accounts, you don't spare time more than 45 to 50 minutes. You have to complete it accordingly. Then for ethics, go for 30 minutes and have to save the time for at least 15 minutes for section B. That will take more time. And moreover, whenever you're working for uh, the cases, apply the rule of PAC. Plan, apply, apply the knowledge and connect with the case. And my rule, what's the rule? For 2 marks, think about 2 points. And you have to put 2 ideas in the on the question, on the answer. That is the point. Getting the point? How to allocate the time. Okay, candidates. Jazakallah khair. Thank you very much. Jazakallah. Assalamu alaikum, everyone.